All right, when I say greatest investor of all time, who's the first person that pops into your head? It's probably Warren Buffett, right? Or maybe Peter Lynch. And of course, they're absolute legends. But what if I told you the best to ever do it wasn't really an investor at all? He was a mathematician, a codebreaker during the Cold War who looked at the market and just saw one giant encrypted puzzle. Wait, a codebreaker? Okay, now you've got my attention. How in the world does that work?
Well, it all kicks off with this number right here, 66%. Whoa, okay, 66%? Is that for like one really good year? Nope. That is the average gross annual return of the Medallion Fund, the fund run by Jim Simon's firm. And get this, it's for over 30 years. That sounds completely impossible. How does a math professor just show up and beat the best on Wall Street for 3 decades straight?
And this chart, wow, it really puts that number in perspective. On the right, you've got the S&P 500. That's the benchmark for the entire U.S. market. It averages around 10% a year, which is great. But Medallion, they weren't just beating the market, they were lapping it over and over again. We're talking more than 6 times the return. It's like they weren't even playing the same sport. Exactly. They were operating in a totally different reality. Which brings us to the central mystery. How?
And that is the exact question we are going to unpack. For them, it was never about trying to pick the next hot stock or reading a company's balance sheet. So it had nothing to do with business fundamentals at all? Not a thing. For Jim Simons, it was all about finding hidden patterns, these faint little signals in all the noise of the market that nobody else could even see. He approached it like an encrypted message, and he was dead set on building the key.
So to really understand the method, you first have to understand the man. Who was Jim Simons? The thing is, he was the ultimate outsider. He wasn't some product of Wall Street. He was a product of places like MIT, Berkeley, and believe it or not, the National Security Agency. His background wasn't in finance, it was in codebreaking. This career path is just wild. A math prodigy gets his PhD at the age of 23, and then he becomes a codebreaker for the NSA? That right there is the crucial step. Think about it. During the Cold War, his entire job was to find non-random patterns in what looked like total chaos. He was hunting for secret messages buried in noisy data streams. And what is the stock market if not the biggest, noisiest data stream in the world? Exactly. It was the absolute perfect training ground.
Okay, so he's a code breaker who starts a hedge fund. I'm following. But what did that actually look like day to day? What was going on inside this famous black box that made it so radically different from every other firm on the planet?
You know, it really comes down to a massive difference in philosophy. Traditional Wall Street is completely obsessed with the why. Why is this company a good investment, right? So they hire all these MBAs to analyze earnings reports, management teams, the whole story behind the business. Renaissance did the exact opposite. They hired PhDs in physics, astronomy, and even speech recognition, people who knew absolutely nothing about finance. All they cared about was the what, as in, what is the price likely to do in the next few moments, based purely on statistical patterns. A speech recognition expert, why would they do that? Because their entire job is about filtering a clear signal, a human voice, from a ton of background noise. It's the exact same problem as finding a tiny trading signal in the chaos of market data.
And this quote right here, it gets to the absolute core of how they thought about things. They were never trying to hit home runs. Just 50.75%? That's barely better than a coin flip. Exactly, it seems almost pointless. But here's the secret sauce. When you have a tiny but reliable statistical edge like that, the key is just massive volume. You make thousands, even millions, of little short-term trades. And that tiny edge, compounded over and over and over again, is what built the greatest money-making machine in history.
Okay, I get the theory. Hire a bunch of scientists, find these tiny statistical advantages, and trade like crazy. But it just sounds a little too perfect, almost too good to be true. Did this bizarre method actually hold up over the long run? Show me the numbers.
The numbers are just staggering. I mean, take the year 2000. The dot-com bubble bursts, the market's in flames, the S&P loses 10%. Medallion? It was up almost 99%. That's just unbelievable. So what about the 2008 financial crisis? The whole market crashed by nearly 40%. It was a total bloodbath. Medallion didn't just survive, it gained over 83%. Their models actually thrived on all that volatility, which proved their strategies had absolutely zero connection to the emotions and the panic of the rest of the market.
So what does that kind of performance really mean for an investor? Well, let's put it this way.
if you had somehow put just $100 into Medallion back in 1988, by 2018 it would have turned into over $2.1 million. $100 became $2 million? You're telling me that's after their fees? That's after their famously sky-high fees? It just goes to show you the mind-bending power of compounding high, uncorrelated returns.
Okay, I am sold. Where do I sign up to invest? Well, you can't, and you haven't been able for a very long time. They closed the fund to all outside investors way back in 1993. But why? Why would you ever turn away money? Because Simons realized their strategies had a limited capacity. The profits were so immense, it was actually better to just turn it into a private wealth creation machine exclusively for the firm's employees and their families.
So, if we can invest in it, and most of us aren't exactly code-breaking mathematicians, what's the takeaway here? What are the lessons that we, in 2026, can actually learn from this secretive, mind-bendingly successful firm? It really all boils down to 4 key principles. First, you have to trust data over your gut feeling. Evidence over intuition. Every time. Second, create systems that take emotion out of your big decisions. Build a plan so you don't panic. Third, and this one is huge, understand that small, consistent advantages compound into enormous success. It's not about hitting home runs, it's about just getting on base every single time. And finally, recognize that the right team matters. Bringing together diverse experts from outside your field can lead to breakthrough solutions you never would have seen otherwise. Which leaves all of us with this final question. Jim Simons found his edge by applying a scientific, data-driven approach to a field that was completely dominated by human intuition. And in our world today, which is increasingly run by data and AI, the principles he pioneered are more relevant than they have ever been. So the question for everyone watching is, where in your life, your career, or your industry is that hidden data edge just waiting to be discovered?